Let me ask you something simple. Have you ever heard someone say the market is bullish or buy the dip, and you just nodded along like you understood? But deep down, you had absolutely no idea what they were talking about? Don't worry. That was me too, not too long ago. And that's exactly why we're here today. By the time this video ends, you're going to understand every major stock market term that people throw around like everyone already knows what it means. No jargon, no complexity. Just plain, simple explanations you can actually use. So let's start from the very beginning. Term 1. Stocks and shares. A stock is simply a small piece of a company. When a company wants to raise money to grow instead of borrowing from a bank, they can sell tiny pieces of ownership to the public. Each one of those pieces is called a share. When you buy a share, you become a part owner of that company. It doesn't matter if it's one share or a million shares, you own a slice of that business. And if the business does well, your slice becomes more valuable. Now that you know what a stock is, the next question is, where exactly do people go to buy and sell them? The answer might surprise you with how simple it actually is. Term 2. The stock market. Think of the stock market like a massive marketplace, except instead of food and clothes, people are buying and selling ownership in companies. In the United States, the two most famous places this happens are the New York Stock Exchange, which people call the NYSE, and the NASDAQ. In Nigeria, it's the Nigerian Exchange Group. Every country has its own version. These are organized platforms where buyers and sellers meet to trade shares every single day. But here's something that confuses a lot of beginners. Once you're inside that marketplace, how do you know what a company is actually worth? That's where the stock price comes in. Term 3. Stock price. The stock price is simply how much one share of a company costs right now. If Apple's stock price is $180, that means if you want to own one tiny piece of Apple today, you need to pay $180. Simple as that. But here's where it gets interesting. This price is always changing. It goes up and down based on how people feel about the company, what's happening in the economy, the news, and 100 other things. That movement is what creates opportunity for investors. And the way people describe that overall movement, whether the market is going up or crashing down, leads us to two of the most famous words in all of investing. Term 4. Bull market and bear market. You've probably heard about bull markets and bear markets. These words confuse a lot of people, but the idea is actually very simple. A bull market is when the market is going up, prices are rising, people are feeling confident, and most investors are making money. Think of a bull charging forward, horns up. That's your memory trick. A bear market is the opposite. Prices are falling, people are scared, and the market is going down. Think of a bear swiping its paw downward. Historically, bull markets last longer than bear markets, which is one reason why patient investors tend to win over time. Now, because markets go up and down, smart investors don't just put their money in one place. They spread it out. And that idea has a specific name you need to know. Term 5. Portfolio and diversification. A portfolio is just the collection of all the investments you own. If you own shares in 5 different companies, your portfolio is those 5 investments put together. People build portfolios because of a very important concept called diversification. Diversification basically means don't put all your eggs in one basket. If you put all your money into one company and that company collapses, you lose everything. But if you spread your money across many companies and one of them struggles, the others can carry you. Diversification is one of the most powerful tools a beginner investor has. But how do you even know if the whole market is doing well or badly on any given day? There's a tool built exactly for that. And you've probably heard it mentioned on the news without realizing what it was. Term 6. Index. An index is like a scoreboard for a group of stocks. The S&P 500, for example, tracks the 500 largest companies in America. It gives you a quick snapshot of how the overall market is doing. If the S&P 500 goes up by 2% today, it means that on average, those 500 big companies became 2% more valuable. The Dow Jones Industrial Average, which people just call the Dow, tracks 30 very large, well-known American companies. In Nigeria, you'd look at the NGX All-Share Index to see how the local market is performing. Now here's something really exciting. What if I told you that you could make money from a stock without ever selling it? That's exactly what the next term is all about. Term 7. Dividends. A dividend is basically a reward that a company pays to its shareholders, usually every 3 months. So if you own shares in a company that pays dividends, they'll send you a portion of their profits just for holding their stock. It's like being a landlord and collecting rent. You don't have to sell your shares to make money. The company pays you just for owning it. Companies that pay consistent dividends are often called dividend stocks, and many people build their entire investment strategy around collecting these payments. Now, dividends are one way to measure a company's health, but there's another number that tells you just how big or small a company actually is in the eyes of the market. Term 8. Market capitalization. Market capitalization, which people shorten to market cap, is simply the total value of a company based on its current stock price. You calculate it by multiplying the number of shares a company has by its current stock price. So if a company has 10 million shares and each share costs $50, the market cap is $500 million. Companies are often described by their market cap size. A large cap company is huge and usually very stable, like a Dangote Group or Microsoft. A small cap company is smaller and might be newer, higher risk, but also higher potential reward. Here's a question. Have you ever wondered how a company goes from being private and unknown to suddenly being available for anyone to buy on the stock exchange? That exciting moment has a name. Term 9. IPO and listing. An IPO stands for Initial Public Offering. This is the very first time a private company sells its shares to the public. Before an IPO, regular people like you and me cannot buy shares in that company. The day they do an IPO, the doors open and anyone can buy in. Getting listed means the company is now officially on a stock exchange, where its shares can be traded freely every day. A lot of excitement usually surrounds IPOs because early investors are hoping to get in before the price rises. Great. So now you can get into a company early. But once you're in, how do you know if that company is actually making real money? That's where this next number comes in, and it's one the professionals check every single quarter. Term 10. Earnings per share, EPS. Earnings per share, or EPS, tells you how much profit a company made for each single share that exists. If a company earned $10 million in profit and they have 5 million shares, the EPS is $2. The higher the EPS, generally the healthier the company. Investors watch earnings reports very closely because when a company announces its EPS, it can cause the stock price to move a lot, up if the results are better than expected, and down if they disappoint. Now that you know what a company earns, the next logical question is the stock price actually fair given what it earns? And to answer that, investors use one of the most important ratios in all of finance. Term 11. PE ratio, price to earnings. The PE ratio, or price to earnings ratio, tells you how expensive or cheap a stock is compared to how much money it's making. You calculate it by dividing the stock price by the earnings per share. If a stock costs $100 and the EPS is $10, the PE ratio is 10. A lower PE might mean the stock is undervalued, a potential bargain. A very high PE might mean the stock is expensive, or that investors expect huge growth in the future. Warren Buffett, the most famous investor in history, uses the PE ratio and similar measures to decide whether a stock is worth buying. But even a perfectly priced stock can be dangerous if its price swings wildly from one day to the next. That unpredictability has a name, and it's something every beginner needs to understand before putting a single dollar into the market. Term 12. Volatility. Volatility describes how much a stock's price moves up and down. A very volatile stock might jump 10% in one day and drop 8% the next. A low volatility stock barely moves. For beginners, high volatility can be scary, but it's also where big gains can happen. Most experienced investors recommend that beginners stick to less volatile, more stable companies when they're starting out, and gradually learn to navigate more volatile ones over time. Now, here's something interesting. What if that scary price drop you're watching is actually not a disaster, but an opportunity? That leads us to one of the most popular phrases in all of investing. Term 13, buying the dip. When a stock price suddenly drops, maybe because of bad news or just general market fear, some investors see that as an opportunity. Instead of panicking and selling, they buy more shares because the price is temporarily lower. They believe the price will recover and go back up. That's what buying the dip means. It takes confidence and patience, but historically, markets have always recovered from dips over long enough periods. All right, you know what to buy and when to consider buying it, but who actually helps you make that purchase? You need a middleman, and that's your broker. Term 14, broker. A broker is a person or company that connects you to the stock market. You don't just walk into a stock exchange and start trading. You open an account with a broker. These days, most brokers are apps or websites, and they execute your trades on your behalf. In Nigeria, platforms like Stanbic, IBTC, Meristem, or Cordros can serve this role. Globally, apps like Bamboo or Rise have made it easier for Nigerians to invest in foreign markets. Once you're with a broker, you'll quickly realize there's more than one way to place a trade, and choosing the right type of order can actually save you money. Term 15, market orders and limit orders. A limit order is when you tell your broker to buy or sell a stock only at a specific price you choose. A market order is when you say buy or sell right now at whatever the current price is. Most beginners start with market orders because they're simpler, but limit orders give you more control. If you don't want to pay more than a certain amount for a stock, a limit order is your best friend. Now, most of us invest hoping prices will go up, but there's a whole group of investors who actually make money when prices fall. And the way they do it is one of the most fascinating and risky strategies in the market. Term 16, short selling. Short selling is when an investor bets that a stock's price will go down. They borrow shares, sell them immediately, and plan to buy them back later at a lower price, keeping the difference as profit. It sounds strange, but it's a real thing professional traders do. The risk is enormous, though, because in theory, a stock price can rise forever, meaning your losses can be unlimited. It's not something beginners should attempt, but you should absolutely understand it when you see it mentioned in the news. And finally, here's the big question that ties everything together. Should you be someone who buys and sells quickly, or someone who just holds on and waits? The answer to that question has made more millionaires than almost anything else in investing. Term 17, long-term investing. Versus trading. A trader buys and sells stocks frequently, sometimes within the same day, which is called day trading. An investor buys stocks and holds them for years, sometimes decades. Study after study has shown that most everyday people do far better as long-term investors than as short-term traders. The market rewards patience. Time in the market beats timing the market almost every single time. So here's what I want you to take away from today. The stock market is not some mysterious world reserved for rich people in suits. It is simply a place where people buy and sell ownership in companies, and every single term we covered today is just a different way of describing that simple activity. Stocks, shares, bull markets, bear markets, dividends, PE ratios, volatility, IPOs. You now know what all of these mean, and more importantly, you know why they matter. The best thing you can do from here is not to rush. Take your time. Start small. Keep learning. And if this video helped you understand even one thing you didn't before, drop a comment below and tell me which term clicked for you today. And if you want more beginner-friendly content like this, make sure you subscribe. Because we're just getting started. I'll see you in the next one.